All right, let's dive in. Today, we're going to tackle the silver market. It often feels like it's speaking its own kind of complicated language. So what we're going to do is cut right through all that noise and give you a simple, quick guide to what the data is really telling us.
I mean, if you've ever tried to read up on silver, you know what I'm talking about, right? You're hit with all this jargon, these weird ratios, tons of stats. It can feel pretty overwhelming. It is so easy to just get lost in all those numbers.
But hey, don't worry about it. Think of this guide as your own personal translator. We're going to take all that complicated market speak and turn it into clear, simple signals. So, let's jump right in.
Okay, first things first. Before we can even talk about the signals, we got to lay down the ground rules. Setting our expectations. And understanding the framework here is absolutely key to getting this right.
So just to make sure we're all on the same page, here's the deal. We're looking at data from 1990 onwards, and we're looking at it on a monthly basis. Now, it's super important to think of these as historical guideposts, not some kind of crystal ball. They show what has happened, not what will happen. And of course, I gotta say it, this is not investment advice. This is all about understanding the data.
And let's double-click on that monthly thing for a second. What that means is we're taking a big step back. We're looking at the forest, not the trees. We're not getting bogged down in the day-to-day or even week-to-week market chatter. No, this is all about the slower, long-term trends that unfold month by month.
All right, now that we've got our rules of the road set, let's get into the good stuff. We'll start by looking at signals that tend to move in the exact same month as silver's price. You can think of these as, well, nowcasters. They're not predicting the future. They're telling us what's happening right now. Okay, before we show you the numbers, we need to have a quick chat about a word you're going to see a lot: correlation. Don't let it scare you. It's just a simple score from -1 to +1. A +1, that means two things move in perfect lockstep. A -1, they're perfect opposites. And a 0, well, that just means there's no link at all. See? Simple as that.
Okay, let's pull up the data. And what's really interesting here is that the strongest link, and I use that term loosely, is from the COT report. It has a correlation of 0.25. That report just tracks what the big speculative players, the managed money, are up to. And as you can see, everything else, the miners, the gold price, even the S&P 500 has an even weaker connection.
But let's zero in on that S&P 500 link for a moment. The correlation is just 0.10. Now, statistically, that's called a mild connection. But let's be real. What does a number that tiny actually mean when you're trying to figure things out?
I mean, it seems basically non-existent, right? There's this common idea that when stocks are doing well, silver should be too. That whole risk-on mood. But this number, it tells a completely different story.
And check this out. This chart really puts it into perspective. Look at what a perfect correlation of 1 looks like. Now look at our 0.10. It's barely a nudge. This is not a strong, reliable signal. It's more of a whisper than a shout. So yeah, while there's technically a connection, it's incredibly faint. And that's a huge takeaway for anyone who assumes these two are supposed to move together. So the takeaway so far? These same month correlations are frankly pretty weak. But what if we look at this from a different angle? Let's ditch the fancy stats for a minute and explore some simple historical if-then scenarios. Old-fashioned rules of thumb that might give us a hint about what could happen over the next year.
And a huge one, probably the most watched signal out there, is the gold to silver ratio. All it is how many ounces of silver it takes to buy 1 single ounce of gold. The best way to picture it? Think of a seesaw. When one side gets pushed way up, what usually happens? History tells us it tends to come back down toward the middle. So let's walk through how this plays out. When that ratio gets really high, let's say over 73, it just means that silver is super cheap compared to gold. And what has happened in the past? Well, the historical tendency is that over the next 12 months, silver often plays catch-up and actually outperforms gold. And we're not talking a little bit. On average, that outperformance has been somewhere between 12 and 17%. Now, there are a couple of other little rules of thumb worth knowing. On the flip side, when the ratio is super low, gold has tended to do better. But we have to admit the data there is pretty thin. Also, when things get crazy in the market, high stress, when the VIX fear index is spiking, silver has often lagged behind gold. And just as a little seasonal tidbit, the first quarter of the year has usually been a pretty good time for silver.
Okay, so those rules of thumb are helpful. But you know what? We can make this even simpler.
Let's translate all these different conditions into easy-to-remember mood tags. It's like a quick shorthand to instantly get the vibe of the market environment for silver.
So here's how it breaks down. If the market's in a crisis mood with that VIX number high, silver has historically had a weak bias. Now the next two are tied to something called real yields. And don't worry, we'll explain that in just a sec. When the mood is dovish, meaning real yields are negative, that's been supported for silver. But when the mood turns hawkish, with high real yields, that's created a real headwind. And neutral? Well, just like it sounds, it's been pretty mixed.
Okay, so I promised we'd talk about real yields. What on earth is that? It's actually pretty simple. It's the interest you earn on a really safe investment, like a government bond, after you subtract inflation. Think of it as a key thermometer for the overall financial climate.
So let's put these two financial moods side by side, because this is really important. In a dovish world, where your safe bonds are actually losing purchasing power because of inflation, suddenly holding an asset like silver, which doesn't pay any interest, looks a whole lot more appealing. But flip that script, in a hawkish world where you can get a great safe return from bonds, well, silver has some pretty stiff competition for investors' cash.
Wow, okay, we have covered a lot of ground here. We've gone from correlations to historical rules of thumb, all the way to these simple mood tags. But, the most important part of all is knowing how to use this stuff wisely.
And here it is, the single most crucial point I want you to take away from all this. These are all just signals. They are not, and I repeat, not a crystal ball. They give us context based on what's happened in the past. They absolutely do not predict the future with any certainty.
And because of that, you always have to consider the bigger picture. A massive shift in policy, a sudden supply shortage, a war. Any of these real-world events can completely steamroll these neat little historical patterns. And frankly, we've seen that happen over and over again in recent years.
There's a quote in the material we base this on that just hits the nail on the head. It says you have to pair signal talk with the real-world supply and demand story. The stats might tell you what is happening, but the real-world fundamentals, that's the why. And you absolutely need both to have a clue what's going on.
And so that leaves us with one last big question to chew on. In a world that seems to throw a new surprise at us every single day, how much weight should we really truly put on the patterns of the past? That right there is the central challenge for anyone trying to make sense of these markets. Something to think about. Thanks for tuning in.